Listen, I want you to picture something vivid, not an abstract case, not a classroom scenario. A real American living room somewhere in suburban Tampa on a Tuesday afternoon in March of 2026. Her name is Linda. She is 68 years old. The casseroles from the funeral are still in the freezer. Her husband Robert, the man she married at 22 in a small church outside Akron, Ohio. The man who worked 38 years as a regional plant manager for a mid-sized industrial parts company. The man who wore the same gold wedding band even after his fingers swelled up from the blood pressure medication. That man passed away 9 weeks ago. Heart failure in the garage on a Saturday morning while he was changing the oil on the Buick. Linda is now sitting at the kitchen table. She has reading glasses on. She has a stack of mail. She has a yellow legal pad. And she has a letter from her CPA that she has now read 4 times because she does not understand it. Cannot process it. Does not want to process it because what the CPA is telling her in careful professional accountant language is that the federal government of the United States of America is about to take approximately $73,000 from her retirement nest egg this year. A nest egg that, by the way, did not get any larger when Robert died because Robert and Linda did everything right. They paid off the house. They funded the 401k. They never carried credit card debt. They drove their cars until the tires fell off. They were the model American middle-class retirement couple. And now the IRS is reaching across the kitchen table and taking $73,000 out of her hand in a single calendar year. That prior year would have been a tax bill of about $18,000. Same income, same accounts, same RMDs coming out of the same traditional IRA. Robert is gone, so the income actually went down, not up. Linda lost one of the 2 Social Security checks, the smaller one, so her gross income dropped by roughly $28,000 a year. She is poorer, she is grieving, she is alone, and her tax bill just quadrupled. That, my friends, is the widow's penalty. And if you are watching this video and you are married, and one of you has a traditional IRA or a 401k with any meaningful balance in it, you need to understand something right now. The IRS is not your advocate. The IRS is not neutral. The tax code contains a mathematical trap that springs the moment the funeral home pulls the hearse away from your driveway. And nobody, not your broker, not your branch banker, not your generic financial planner with the framed CFP certificate on the wall. Nobody is telling you about this issue until it is too late to do anything about it. I'm going to tell you about it right now for the next 30 minutes because I am tired of watching surviving spouses lose 6 figures of their late partner's life work to a tax code that was structured mathematically and intentionally to burden the single filer. Before I take one more breath, do me a favour. Hit the like button right now. I am not asking. I am insisting. Because the algorithm in 2026 has a documented visibility problem on senior financial education content. The platforms do not prioritise this video reaching the people who need it. The IRS benefits from quiet, isolated grieving spouses sitting at kitchen tables with no advocate. Every like on this video pushes it into the feed of one more couple who still has time to address this. Subscribe. Flip the bell. Join the archive before the system shuts down senior financial education entirely. We are building a private library of planning guides here, and you are going to want access when the letter arrives. Now let me tell you what actually happened to Linda mathematically, word by word, so you understand the size of the damage. In 2025, Robert and Linda filed married filing jointly. Their combined income looked like this. Robert had a monthly Social Security check of $3,100. Linda had a monthly Social Security check of $1,900. Combined, that is $60,000 of Social Security. Robert had a small defined benefit pension from the company paying him $18,000 a year. They had a traditional IRA with a balance of $740,000, mostly Robert's old 401k rollover, and his RMD that year was about $28,000. They had a taxable brokerage account at Schwab worth $220,000, mostly index funds, throwing off about $6,000 a year in qualified dividends, and they had 3 CDs at the local credit union, totaling $110,000, paying about 4%, generating $4,400 in interest. Add it all up, $60,000 in Social Security, $18,000 in pension, $28,000 in RMD, $6,000 in dividends, $4,400 in CD interest. That is $116,400 of gross income as a married couple in 2025. Now look at the maneuver the IRS plays here. As a married filing jointly couple in 2025, Robert and Linda got the standard deduction of around $30,000. They got the additional age 65 plus deduction, which added another roughly $3,000. They got the senior bonus deduction created by recent tax legislation, $6,000. Their taxable income dropped to roughly $77,000. And here's the beautiful part of being married, the part the IRS dislikes, and the part you are about to lose. The 12% bracket for a married filing jointly couple in 2026 stretches all the way up to roughly $97,000 of taxable income. So Robert and Linda paid 10% on the first chunk and 12% on the rest. Their total federal tax bill was somewhere around $8,400 on $116,000 gross income. That is an effective rate of about 7%. Here is the part they hide. Robert dies in January of 2026. Linda is now a single filer for the entire 2026 tax year because the IRS uses your filing status as of December 31st. There is a small grace period called qualifying surviving spouse, which extends MFJ rates for 2 years, but only if you have a dependent child living with you. Linda's kids are 41 and 38. They do not live with Linda. They have their own mortgages. Linda gets no grace period. None. She files single in 2026. Her income for 2026 looks like this. She loses Robert's Social Security check. So the household Social Security drops from $60,000 to $37,200. Robert's company pension had a 50% survivor benefit, so the $18,000 becomes $9,000. The traditional IRA still has the same balance around $720,000 by year end. And her RMD as the surviving spouse is still in the high 20s, let us say $27,500. The brokerage still throws off $6,000 in dividends. The CDs still pay $4,400. Add it up. $37,200 plus $9,000 plus $27,500 plus $6,000 plus $4,400. That is $84,100. Linda's gross income dropped by $32,000. She lost a third of the household income. She is poorer than she was when Robert was alive. Now, watch what happens next, because this is the part that should make you absolutely alarmed. As a single filer in 2026, Linda's standard deduction is cut in half, roughly $15,750. She still gets the age 65 plus add-on for a single filer, around $2,000. She still gets the senior bonus deduction of $6,000. Her taxable income is now around $60,350. Here's the math the IRS never wants you to do. The 12% bracket for a single filer in 2026 ends at roughly $48,475. Linda's taxable income is $60,350. So she has crossed the 22% line. She is now paying 22% on every dollar between $48,475 and $60,350. Her total federal tax bill is now around $7,700 on the regular tax. But here is where the second blade drops, because her provisional income is now high enough that 85% of her Social Security becomes taxable. And the way the IRS calculates that for a single filer is much more aggressive than for a married couple. The provisional income threshold for a single filer is $25,000. For a married couple, it is $32,000. The IRS shrunk the protection. So suddenly Linda's Social Security, which used to be partially shielded, is now fully exposed. But that is just the tax bill. We have not even talked about IRMAA yet, the income-related monthly adjustment amount, the Medicare premium surcharge. While Robert was alive, their joint income kept them under the IRMAA threshold for a married couple, which in 2026 sits around $212,000 easy. They paid the standard Part B premium. After Robert dies, Linda is now measured against the single IRMAA threshold, which begins around $106,000 of modified adjusted gross income for the highest tier free zone. But the very first IRMAA tier kicks in much lower, somewhere around the upper double digits, depending on the inflation adjustment that came out of the IRS in November. Linda's MAGI, including the full RMD and the now mostly taxable Social Security, lands her in the first IRMAA bracket. Her Medicare Part B premium goes from the standard rate of about $185 a month to roughly $260 a month. Her Part D drug plan gets hit with a $13 surcharge. That is a roughly $900 a year hit annually for the rest of her life recurring because she experienced the loss of a spouse. Layer the federal tax, layer the new Social Security inclusion, layer the IRMAA surcharge, layer the loss of Robert's income. And the woman who was sitting at 60% of the household tax bill last year is now paying roughly 4 times the tax she was paying as a couple on less money. That is not a glitch. That is not bad luck. That is the federal tax code working exactly the way it was written. Pause the video right now. I want you to do one thing. Go to the comment section. Tell me honestly, have you and your spouse ever sat down and run this calculation? Have you ever modelled what your taxes look like the day after one of you dies? I am betting 95% of you watching have not because nobody told you to. Tell me your situation. Tell me your ages. Tell me roughly what is in the traditional IRA and what your pension survivor benefit is. We're going to analyse the exposure together. The comment section is the field office. Drop your field report. I read every single one. Now let me walk you through the 3 layers of this trap, because Linda's story is just the surface. The widow's penalty has 3 distinct mechanical traps stacked on top of each other. And most CPAs only ever talk about the first one. They miss the second. They miss the third. And the third one is the one that quietly drains the surviving spouse for the rest of her life. Trap number 1, the bracket collapse. We just walked through it. The 2026 single filer bracket structure, even after recent law made the lower TCJA style brackets permanent, is roughly half the width of the married filing jointly brackets at almost every level. Look at the 22% bracket. For a married couple, it goes from $96,950 up to $206,700. That is $110,000 of bracket width. For a single filer, the 22% bracket goes from $48,475 to $103,350. That is $54,000 of bracket width. The single filer's bracket is mathematically half the married filing jointly bracket. This is true at the 24% line. It is true. At the 32% line, the whole architecture is built for couples, and the second one of them dies. The survivor falls through a trapdoor. Trap number 2, the RMD crossfire. This is the one that catches people who think, well, I will just live off less. The IRS cannot tax me on money I do not spend. Wrong. The required minimum distribution does not care what you spend. The RMD does not care that you are grieving. The RMD does not care that you only need $18,000 a year to pay the property taxes and the groceries. The RMD pulls money out of your traditional IRA at a percentage dictated by the Uniform Lifetime Table, and that money becomes taxable income, whether you spend it or stuff it under the mattress. At age 73, your divisor is roughly 26.5. At age 75, the divisor drops. By the time you are 80, you are pulling out close to 5% of the entire balance every single year. By 85, almost 7%. The IRS forces the income out, and that forced income in a single filer bracket gets taxed at rates that would have been impossible for a married couple. That is the crossfire. The forced withdrawal mechanism plus the narrowed bracket equals severe tax pressure. Trap number 3, the IRMAA spike. I touched on this with Linda, but understand the full machine. IRMAA is not just about the Part B premium. It is about a 2-year look back. Your 2026 income determines your 2028 Medicare premiums. So, if you do something this year that spikes your income, like, oh, I do not know, finally getting around to doing a Roth conversion, in the year after your spouse died because your CPA finally woke up, you just bought yourself a 2-year IRMAA penalty that will not show up on your bank statement until 24 months later. The system is designed with delay mechanisms specifically, so you cannot connect cause to effect. By the time the higher Medicare premium hits, you have forgotten what you did to trigger it. That is not an accident. That is engineering. 3 traps stacked, fired sequentially. The bracket collapse hits the year of death. The RMD crossfire hits every January for the rest of the survivor's life. The IRMAA spike hits 24 months after every income event. There is no easy escape once the funeral is over. There is only preparation before. Which brings me to the architect. Who designed this? Who sat in a room and decided that the cleanest way to draw generational wealth from the American middle class was to wait until one spouse died and then change the tax math so dramatically that the surviving spouse in her grief would not have the cognitive bandwidth to fight back? I will tell you who the Joint Committee on Taxation has known about the widow's penalty since the 1980s. There have been white papers. There have been think tank reports. Brookings has written about it. The American Enterprise Institute has written about it. AP has written about it cautiously. The information has been sitting in plain sight for 40 years. Every Congress that has had the chance to fix it has chosen deliberately not to. Why? Because the widow's penalty is one of the largest sources of stealth revenue in the entire federal tax structure. There are roughly 800,000 new widows and widowers in the United States every year. The average financial profile of a 65-plus widow includes a traditional IRA balance somewhere between $250,000 and $1.5 million. The marginal tax rate jump from the bracket collapse alone, multiplied across that population, generates billions of dollars annually in incremental federal revenue. The IRS calls this revenue. You and I call it an unfair burden on the grieving. Send this video to a married couple you care about. Right now, today, not tomorrow. Not when you remember, today. Pull out your phone, hit the share icon, and send it. One conversation now between two spouses, still both alive, saves the surviving one of them roughly $75,000 over the next decade. That is not a sales pitch. That is the math we just did with Linda. The cost of inaction is 6 figures. The cost of a 30-minute conversation tonight after dinner is 0. Send the video. Help the spouse. Now let us get to the strategy. The 4 assets you should review before the funeral. Asset number 1, the traditional IRA, or the traditional 401k, or the SEP IRA, or any pre-tax retirement account. This is the single largest source of widow's penalty damage in the typical American retirement portfolio. Why? Because every dollar in a traditional account is a dollar of future ordinary income. The IRS owns a percentage of that account. They have not collected yet. They are letting it grow because they get to apply a higher tax rate to a bigger pile later. When the first spouse dies, the surviving spouse inherits the traditional IRA, and now every RMD comes out at the single filer rate. The fix, Roth conversions, aggressive multi-year planned Roth conversions while both spouses are still alive, and filing married jointly. This is the single most important tax move in the entire pre-death planning playbook. Here is why it works. While you are married and filing jointly, you can fill the 22% bracket all the way up to $206,700 of taxable income. That is a massive runway. You can convert $100,000 from traditional to Roth in a single tax year. Pay the tax now at 22%, and that money becomes permanently tax-free. No RMDs ever. No tax on growth. No tax on withdrawal. And critically, when one spouse dies, the surviving spouse inherits a Roth IRA, which does not generate any taxable income whatsoever. Run the math. If you have $800,000 in a traditional IRA at age 68 and you do nothing, your surviving spouse will pull conservatively $28,000 to $45,000 a year out of that account every year for the rest of her life, all taxed at the single filer rate plus IRMAA plus the Social Security inclusion penalty. The lifetime tax cost on that account post-widowhood is somewhere between $180,000 and $240,000. If instead you convert that account to Roth over 6 years at the 22% and 24% brackets while both spouses are alive, the total tax paid is roughly $180,000 on same money. But the Roth then grows tax-free. The surviving spouse pulls money out tax-free, and there is no IRMAA spike from the withdrawals because Roth distributions do not count toward MAGI. You convert a recurring tax liability into a one-time tax payment, and you do it in the wider married brackets. That is the move. Asset number 2, the taxable brokerage account. This one is counterintuitive, and most CPAs get this exactly wrong. They tell couples to gift appreciated stock during their lifetime to lower the estate. That is often poor advice for a married couple where one spouse may die first. Here is the powerful rule nobody talks about. Internal Revenue Code, Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the survivor, the cost basis of those assets resets to the fair market value on the date of death. All the embedded capital gain disappears, erased. The IRS forgives it. So if Robert bought $100,000 of an index fund in 2005 and it is now worth $240,000 when he dies, In 2026, Linda inherits the fund with a fresh cost basis of $240,000. She can sell it the next day. Zero capital gains tax. The $140,000 of embedded gain is forgiven by the federal government. But here's the trick. This only works if the asset is owned correctly at the time of death. If the brokerage account is in joint tenancy, with the rights of survivorship, in a non-community property state, only 50% of the account gets the step up. The other 50% retains the original basis. If you live in a community property state like California, Texas, Arizona, or Washington, you get a 100% step up on jointly held community property. Florida and Ohio do not. New York does not. Georgia does not. So, the strategy is to title your taxable brokerage account before death in a way that maximizes the step up. In a community property state, do nothing dramatic. Just confirm your account is held as community property with rights of survivorship. In a non-community property state, you may want to use a joint revocable trust with specific community property language, or in some states a TBE designation. Talk to a real estate planning attorney, not a generic CFP, about this. The wrong titling on a brokerage account costs the surviving spouse tens of thousands of dollars in unnecessary capital gains tax. Asset number 3, the unprotected pension. This is the silent threat. Most pensions by default are paid out as a single life annuity, unless the retiring spouse affirmatively elects a joint and survivor option. The single life option pays a higher monthly check while the retiree is alive, but pays zero after death. The joint and survivor option pays a smaller monthly check but continues paying usually at 50 or 75 or 100% to the surviving spouse for the rest of her life. The IRS, by the way, requires the non-retiring spouse to sign a notarized waiver to elect single life on a qualified plan. Most people sign that waiver without understanding what they are doing. The fix has multiple flavors. If you are pre-retirement, elect the highest survivor percentage you can afford, even if it lowers your monthly check. If you are already retired and locked into single life, you cannot reverse it. But you can buy a permanent life insurance policy on the pensioner's life with a death benefit size to replace the lost pension stream. This is called Pension Max strategy, and it has been around for 40 years. The mechanics are straightforward. The pensioner takes the higher single life payment, uses some of the differential to fund a guaranteed universal life policy, and when the pensioner dies, the surviving spouse gets a tax-free death benefit that she can use to buy an immediate annuity or simply invest. The death benefit is income tax-free under Internal Revenue Code Section 101A. The replacement income is therefore tax-free. No bracket collapse exposure, no IRMAA spike, no RMD. The pension is converted mathematically into a tax-free survivor income stream. Save this video right now. Hit the bookmark. Hit the favorite icon. Hit whatever your platform calls the save button. Because when the letter comes, when the CPA calls, when the funeral home hands you the death certificate, and the next thing you know, you are staring at an IRS notice. You are not going to remember the details I just gave you. You are going to need a master checklist. This is that checklist. Save it to your private library. This is your planning manual. Asset number 4, the high-yield bank CD and the taxable bond portfolio. The fourth asset is the slow leak. Most retirement age couples have somewhere between $50,000 and $300,000 in CDs, money market funds, or treasury bonds, generating interest income every year. That interest is fully taxable as ordinary income at the federal level. While both spouses are alive, the interest is buried inside the wide married filing jointly brackets. The day one spouse dies, the same interest stream gets pushed into the narrower single brackets and may push the survivor across an IRMAA tier. The fix is to restructure the income from these accounts before death, so it produces tax-free or tax-deferred output. 3 options. 1. Replace high-yield CDs with high-quality municipal bonds from your home state. Interest from in-state municipal bonds is exempt from federal income tax under Section 103 and exempt from your state income tax. The interest still counts toward the Social Security inclusion calculation. So you do not get a perfect outcome, but you eliminate the federal income tax line entirely. 2. Shift the cash into a multi-year guaranteed annuity, an MYGA, which compounds tax deferred. The interest does not show up on your 1099 every year. It accrues inside the wrapper. The surviving spouse can then take the money out strategically in low-income years. 3. Fund a modified endowment contract or a properly structured cash value life insurance policy. The growth inside the policy is tax-deferred. Withdrawals up to basis are tax-free, and any death benefit pays out income tax-free. 3 options, 3 different state examples. Florida resident, no state income tax. So the muni bond strategy is less powerful. Use the MYGA or the cash value insurance instead. Ohio resident, moderate state income tax. The muni bond strategy is decent. Especially Ohio issued munis for double tax exemption. California resident, high state income tax. The muni bond strategy is extraordinarily powerful. California issued munis can effectively yield the equivalent of a 6 or 7% taxable bond for a high bracket retiree. Now look at what you have done if you executed all 4 moves before the first spouse died. The traditional IRA was converted to Roth, so the survivor inherits a tax-free account. The taxable brokerage was titled correctly, so the survivor gets a full step up in basis and pays 0 capital gains tax. The pension was either elected as joint and survivor or replaced with a life insurance death benefit. So the survivor gets a tax-free or pension equivalent income stream. The CDs were converted to munis or insurance products, so the recurring interest income is removed from the single filer tax exposure. The widow's penalty is mathematically reduced. That is step 1. Step 2 is finding a fee only fiduciary advisor or an estate planning attorney who actually understands the widow's penalty, not a salesman who wants to sell you a product. Bring the notebook, run the math, build the plan. If this video helped you or concerned you or made you furious, do 3 things before you close the app. Like the video, subscribe, and flip the bell so the next planning manual lands in your feed the moment I publish it. Comment with your situation. Tell me what state you are in, roughly what is in your IRA, and whether your pension has a survivor benefit. I read every comment. We build the analysis together. Share this with one married couple you love. One today, not tomorrow. The IRS is patient. The IRS is waiting. The IRS has built the trap and is sitting back watching the calendar, knowing that in this country, 800,000 new widows will fall into it this year alone. You do not have to be one of them. Your spouse does not have to be one of them. The tools exist. The tax code, ironically, contains the escape hatches inside the same chapters that contain the trap. You just have to read them before the funeral. I will see you in the next one. Stay sharp, stay focused, and for the love of everything, review those 4 assets before the IRS gets the chance.